Today we're talking about other people's investments, or your liabilities, or debt. So below you'll find a link to Project 5. What your job is that after you go through these next few lectures, you should be able to figure out kind of the best mortgage and kind of student loan strategy for a hypothetical situation. You're also going to discover kind of whether renting or buying is a better option in a specific scenario and what you should be taking into account. So it's a pretty fun project. I've put a lot of time and effort into it to try and make it as realistic as possible so that you can make a much better informed decision regarding your own renting or buying decisions and student loan decisions. But we're going to start with some debt terms and also do an overview of credit scores, how they work, how they operate, how they're used. So how does all the debt break down that's out there, say, in the United States? What does it look like? Well, the vast majority of it is housing debt. I mean, nearly $10 trillion, right around there, $10 trillion of housing debt. And non-housing debt makes up a much smaller portion of the total. But if you were to break down just the non-housing debt balance, it's pretty interesting to look at. So what you'll notice that over the last 15 or so years, the amount of student loans has just exploded. It's increased dramatically. Other forms of debt has remained relatively stable. Credit card debts remained relatively stable. And the other area that's has really increased is auto loans, especially subprime auto loans. It's become relatively easy to get a very significant or large auto loan. Now check out the articles below, and you probably also remember from earlier, but just to recap some terms on debt. So debt is you owe someone money, and the principal is the initial amount of money that you borrow. The interest is that cost to rent that money. That's what's owed beyond the principal. The creditor is who lends the money, and the debtor is the person who receives the money and then owes it back to the creditor. When debt is overdue, a payment is overdue. It means you had an obligation to make a payment on a certain day, and then that payment did not occur. Default is when debt is overdue beyond a certain number of days. 90 days is kind of the default. For lack of a better term, pun intended. A couple more terms. One is collateral. Collateral is something that the creditor gets to take in the case of default. And finally, repossession is the act of when the creditor actually seizes this. So the creditor repossesses the collateral. Now, debt has existed since time immemorial, but to best understand the situation of debt and how it operates, let's just walk through an example. Like, would you lend me money? What would you want to know before you lend me money? Well, throughout time, we've kind of boiled all these concepts down into what's called the 3 C's, sometimes called the 6 C's, but the 3 C's is pretty straightforward, and that's what we're going to go with here. The first is the ability to pay. So, am I going to actually have the money in the future to pay you back? This is called the C of capacity. The second is the willingness or propensity to pay. So, if I have this money in the future, am I going to pay you back? Or am I going to blow it all on a lot of Sour Patch Kids? Now, that is a reflection of my sometimes called character. And the third is capital. So if I don't have the money to pay you, do I have other assets that maybe I could sell and then I could pay you? Or maybe there's certain collateral that says, if I don't pay you, then you get to take, say, my house or my car or something like that, so that you can try and recover your losses. And this C, unsurprisingly, is called capital. We're diving in deeper on the first characteristic, the ability to pay. So, will I be able to pay back this debt of this money that you lended me? Well, that ability to pay is based off of how much money I make today, but also how much money my income is going to be in the future. It's also based on my levels of debt and any other obligations that I would have in my life, like child support, alimony, etc. All of those things tend to be requested whenever you're borrowing. So from your perspective, you want to take into account all of the downside risks of bad things that could happen in my life that would cause me to not have the funds to pay you back. So those downside risks. Some of those are taken into account. Some other downside risks are not taken into account. Sometimes life expectancy, health, they're either not taken into account or it's illegal to take them into account depending on the context. So you want to protect yourself because you're lending me money, and you want to adjust for these downside risks, but there's certain downside risks that you're not able to adjust for. Also, you are going to take into account the economic conditions going forward. And so maybe it has nothing to do with me, but say the economy's doing poorly, you're going to say, hey, you know what? I don't feel comfortable lending you money because the economy's doing really poorly, and it's no reflection on my character, or my ability to pay, or anything like that. And that's something that, I guess I can't take that personally. Now, the second characteristic on you deciding whether you are going to lend me money is my willingness to pay, or sometimes called propensity to pay. So if I have the money, am I going to pay you back, or am I going to do something else with it? Because, I could pay you back, but that's not fun. I want to do more fun stuff with it. So if I do only have a certain amount of money, who gets paid first? Who gets paid second? Who gets paid third? And this is actually really tricky to measure this. And, why do you think that this might be really, really hard to measure, is willingness to pay? Well, if in order to predict whether someone's going to be willing to pay you, you'd have to think, well, what correlates to somebody being willing to pay? And a lot of those things are very, very difficult to measure. Now, there are certain things that kind of correlate with it, but it's very difficult to measure those things. And it might not be an accurate depiction of that person's actual willingness to pay. So this is kind of a fuzzy area. We know that it's the case and that it's important. It's just probably one of the hardest things to measure. Now, the third characteristic of what you're going to look at in order to decide whether you're going to loan me money is capital. Before we dive into this, let's discuss really quick two terms. One is secured debt. So secured debt is backed by collateral. So say you lend me money so I can buy a home. So I have this mortgage. And if I don't make my payments to you, then you basically get to take my house. So you are motivated, I am motivated rather, to make these payments back to you. Otherwise, I lose this collateral. Also, you are protected because if I don't make these payments, then you at least get something out of it. Now, with unsecured debt, that just means I promise to pay you back. There's no collateral that's at play. So with capital, there's kind of two categories. One is collateral, whether it's secured debt or unsecured debt. The second aspect of capital is maybe I owe you money, but I have some other asset, say a home with no mortgage on it, and I could sell that home in order to pay off you. If I, say, didn't have the income, but I had other capital to pay you off. And that's why this is called capital as a category. So what are types of things that creditors can take instead? Well, it could be collateral as a car. It could be collateral in terms of a house. It could be jewelry. It could be lots of things. But actually, in reality, very few creditors actually want your stuff. Maybe there are some kind of predatory creditors out there, but for the most part, the bank is just hoping you don't default, even if they're going to likely recover all of their funds, because that's not what banks are in the business of doing. They don't like buying and taking over homes. They want to lend you money and have it repaid. So most of the benefit of collateral for a lender is actually to motivate me, for me not to lose my home when I don't pay my mortgage or some other debt that I have, or an auto loan or something like that. So this motivation in my life, because there's collateral, will hopefully help me find ways in order to increase income, decrease expenses, and make my loan payments. And one example of this would be very few people default on their mortgages when they have at least a 20% down payment on the house. And, in my situation, let's say I have this mortgage, I'd be unwilling to walk away from all of, tens of thousands of dollars, my home and all of its history. And also you feel better lending money to me because, worst case scenario, you still get, I'm motivated to pay you back. And on top of that, in the worst case scenario, you can at least sell the home and probably recoup your investment. So in the event of me defaulting, you as the creditor can legally exercise this right to take possession of this asset, like my house, car, etc. And that is this third characteristic, capital. Now, a couple more details on collateral specifically, which is the subcategory within capital. As far as what can be collateral, I mean, really it could be anything that stores wealth well, and it can be painful for the borrower to give up, and it could be easy for resale. I remember in the good old days when someone couldn't come up with the money at, say, a gas station in a small town, I'd seen this happen, where they couldn't come up with the money to fill up their car with gas, they would leave their shoes with the gas station attendant, not because those had any resale value, but the person wanted their shoes back and they needed to run home, grab some cash, and come back. So those were actually kind of a real but also kind of silly example of collateral that actually worked. So as far as for standard things, house, car, land, jewelry, but there are more exotic types of collateral than you think. I mean, for upscale, you could think rare art. There are those with high incomes or high wealth that need, say, a loan, and so what do? They put up rare art as collateral. In the downscale market, there are, say, pawn shops with, say, guns or other items that they can provide in a pawn shop as part of a loan. Of course, there are legal limits to this. You can't do, say, a Rumpelstiltskin and use a child as collateral or something like that. Now let's walk through an example from my life. So I once lent $2 to someone in middle school, the kid who sat next to me in my science class. Now, I didn't really think this through. He asked to borrow $2, and I just did it. I don't know why. But as far as his ability to pay, he had given no indication of any abilities to pay. Propensity to pay, this is not someone who I would generally characterize with high propensity to pay. On top of that, I had no collateral whatsoever, and I don't think there was any other capital that he could liquidate in the event that he couldn't pay the $2 back. And really, this was kind of the moment when I lost faith in humanity, because when I went to school the next day, he said, "I don't know what $2 you're talking about." And I was just like, man, humans are the worst. He just totally lied to me and stole my $2. So that was a lesson learned for me. But you know what? There can be creative forms of collateral. The month after that, I noticed he was trying to cheat off of me on the science exam. So I purposefully wrote every single answer wrong. And then I waited for him to turn in his test. And then I fixed all my answers and he got a 0 on the exam. That's probably overkill as far as collateral goes. But there can be exotic forms of collateral. Let's make sure you've mastered this. Below I have some different scenarios, some different examples. And what I want you to do is to go through each example and to come up with a story. For example, we'll say example 2. So you lend me money and I lose my job, so I don't have the ability to pay you back. But if I had the money, I definitely would pay you back. So propensity is there. But unfortunately, there's no other collateral or there's no other capital that I'd be able to sell off in order to pay you back. So in this scenario of example 2, I would not repay you. So hopefully that makes sense. And please walk through these examples. Make sure you can come up with a story or a scenario where you'd be able to explain each one. Now we start getting into all of the things that lenders do to track you down and keep track of your history and figure out your ability to pay and willingness to pay. So below there's some information and an article on what exactly goes into a credit report. But to break it down very quickly here, first there's your personal information. So who are you? And hopefully it's the right you. That can be wrong occasionally. As well as, address changes, stuff like that. Second item is your accounts of your credit history. So how much have you borrowed? What have you paid off? What does that look like right now? And what does that look like going back? Third category is inquiries. So how many people have looked at your credit report? And there's a difference between soft inquiries and hard inquiries, which we'll touch on a little bit more later. And finally, negative items. So any late payments or collections or anything that you didn't pay is also going to go on there. So there's these 4 general categories of what you'd expect. So who creates these newfangled credit reports? In the United States, there are 3 companies. They are Equifax, TransUnion, and Experian. And one important thing to note is that the credit reporting agencies, they're primarily just reporting whatever lenders lenders report to them about you. And so if there is incorrect information, you need to make sure they have the correct information. But a credit report is not the same as a credit score. The credit reporting agencies, they provide the information. So where does this credit score come from? There's more details in an article below, but your credit score is created using your credit report. And so with this history of transactions, there are other companies, say FICO and others, who generate a number to assess your risk. It's important to note also that credit scores are this indirect measure of your willingness and ability to pay. But the credit reporting agencies, they don't know per se your net worth or how much cash you have on hand and those other pieces of information. And so they only can tell you part of the story. As far as your credit score can go, most standard measures of credit scores are measured between the score of 200 and 850. As far as what's considered high and low or good and bad, generally 680 and above is considered okay, and above 740 is considered good. The average score in the United States is around 710. So above 680 would be a little bit below average, but still in the okay range, whereas 740 would be considered good and above average. So how do I get a good credit score? That is a great question, and there's a good article below. And we're just going to hit a summary of the points, but you really need to delve into the details to really get a better grasp of each one of the 5 elements of where a credit score comes from and how to improve that score. So first of all, it's payment history. Are you paying on time? Are you paying late? Are you paying not at all? There's the amount of debt that you have that you're carrying. There is the length of your history. So how long have you had, say, your credit cards, your auto loan, mortgage, whatever it happens to be? 4 is new credit. How much new credit has hit your account recently? And finally, credit mix. What's the balance of money that you owe across the different types of loans that exist that are out there? Now, your payment history simply steps through a series of questions. For example, have you paid on time, yes or no? Assuming no, how long ago did you not pay on time? Was this last month or was it 5 years ago? Then there's how late did you pay? Was it 30 days late or was it 90 days late? So how many late payments do you have? Did it happen once, or did it happen every single month, or does it happen 2 or 3 times a year? Finally, how much did you owe on that late payment? Now, a quick life pro tip. If you pay on time, you don't have to worry about any of the other questions. So again, making sure that you have the proper amount of liquidity so that you can meet your debt obligations is extremely important. So with the second category of amount of debt, first of all, how much do you owe in total? And also, how many accounts do you have? So I have a total of, say, $20,000 owed, and that could be across, say, an auto loan and some credit cards. How many of these accounts have an outstanding amount? So if your credit card balance is 0, then it's 0. But if your credit card has, say, your balance for that month, there's also the amount that you owe, say, on your mortgage or, say, on an auto loan. Also, there's the credit utilization. And the credit utilization is simply how much debt do you owe divided by how much credit you have access to. So simple example, $1,000 is the maximum limit I have on my credit card, and I'm using $200, so therefore my credit utilization is 20%. The lower that credit utilization is, that will increase your credit score. Now with length of history, the short definition of length of history is like, have you been around long enough so that we can tell if you're going to pay or be unwilling to pay? So back to my example from middle school, I didn't have any experience or knew of any experience lending $2 to this individual, and so the length of history, credit history, is extremely short. So this includes the data of all these different credit lines you've created. And one of the advantages of, say, keeping an older credit card or something like that is that what they're going to be looking at with to calculate your credit score is what is your oldest credit card, your oldest line of credit, and also your average age of your line of credit. So if you have say one credit card that you got 10 years ago and another one that you just barely got just now, then say your average credit line age could be looking like 5 years between the two. So this is one of those reasons why people like to hold on to their first credit card for a very, very long time. One of the primary benefits of that is that it can keep that credit line open longer and will boost their credit score and helps them get access to loans or rates that they otherwise wouldn't be able to get. With new credit, the primary question is how many people have been looking at your credit recently? So why do you think that's the case? So another way of phrasing this is how many new accounts, say, have you opened up recently, and how would that be an indication that things are going poorly for you? If suddenly you go out trying to borrow money from every single available source and asking everybody you know, that might be an indication that things are going perhaps poorly in your life, and so your credit is going to take a hit. The last area is credit mix, and isn't the most important category, but it's there. And really, do you have experience with a variety of different types of credit? Say credit card, auto loan, mortgage. And so if you have experience with different types of credit, then it shows like this person is used to borrowing under different types of credit and paying back under different types of credit. It shows experience. So what kind of debts could you potentially have? Well, you could think student loans, auto loans, mortgages, etc. But this doesn't mean that you should say, well, I want to increase my credit score, so I'm going to go Pokemon style and try and catch them all. This is the least important factor, so don't worry about it if you don't have a wide variety of loans. There's a decent chance that it's not going to hugely affect your score anyway. Now, different scoring agencies use different weights and different methods for calculating your credit score. But very briefly, so with FICO, with one of their primary algorithms, what you're looking at is about 35% on your payment history, 30% on your amount of debt, and which makes sense. How much debt you have and how have you been performing in the past should pretty much determine if you can borrow or not. Then you have the length of your credit history, going back if you've been around long enough so that they have an inkling of whether you'll repay. And finally, bringing up the rear of new credit and credit mix as the least important categories. Now, why should you care? There are a couple examples in the articles below. But for one, if, say, you had a high credit score versus a low credit score, you would save on average around $90,000 over the course of a 30-year mortgage. Let's say you want to live somewhere. Well, if you want a mortgage, you probably need a decent credit score. Also, there are many apartment complexes that will check your credit score to see if it's different. Also, as far as jobs go, there are many jobs that do credit and background checks as part of just like the standard process within HR at many companies. They're thinking, oh, this person had a bankruptcy. We don't want that person to manage our money. Now, that might not actually be a statistical indication of job quality, but for some reason, people might use it that way. Now, some people might say, what you're trying to tell me is that if I get behind on my payments, I'm not going to have a job or a place to live, and my life is just going to fall to pieces. And of course, it's not that drastic, but it is true to some degree, to some small degree. And this is where I think, say, there's advice out there of having no credit whatsoever, staying completely away from credit cards. Now, for some people, that's a great approach. But for those people who are trying to, say, increase their credit scores, there are certain actions that you would need to take. And getting a credit card would be one of those steps that you would need to take in order to start increasing your credit score. So for the typical 20-year-old college student, how could you how could you start to establish a decent credit score? Well, remember the number one most important thing, pay on time all of the time, including credit card balance. Number one, most important more than anything. So how do you do that? You don't buy stuff you can't afford. Going back to the very beginning of what we've covered. Also, you can check your credit report to make sure that it's correct. There's nothing fishy going on with them. And you can do it across the 3 agencies once a year. So you could stagger that out or do them all at the same time. However, there are sites out there like Credit Karma or Mint where you can get your credit reports for essentially free. And you can obtain pretty much all of the details that are in your normal credit report, which is very convenient, and you can get those on a more frequent basis. Next, if you don't have a credit card, you should probably get one relatively soon, because remember, how long you've had credit is a major category in establishing your credit score. So need to establish a credit card early, and then over time your average age of credit is just going to go up and up and up. And this is something relatively easy to do. I mean, if you want to keep your life simple, you get one with no annual fee, put some simple monthly expense on it, set it up for auto pay, and just move along. If that's the most you want to do, at least you've established that average age of credit. Finally, is you eventually want to start looking to increase those lines of credit from, say, a credit card with a $500 limit to expand that to a higher value, so you're not consuming as high a percentage, as high a utilization of your credit. Now, a final comment on credit scores. A credit score it's just a score. It is not your value. It is just a number. Don't sweat it if things aren't going as well as you'd hope, and it's something that you can work on over time to slightly increase it. And for example, my credit score could be higher, but I really haven't borrowed any money recently, and I paid off a few debts. So I get penalized for that with a slightly lower credit score over time. And you know what? That's okay. And so you just do what you can, and then you don't sweat it. Credit score obsession is very much a real thing, but this doesn't mean that you can just blow off paying your credit card on time, which would also be a very bad idea.